the current gold-backed fiat is fast becoming the yuan.
Oh yeah,
All
yeah,
go,
yeah,
no, there's no yuans, China's wrecked, all they want. The
yeah, yeah.
nation that stacks the gold and is quietly moving to eventually making an announcement is quietly becoming the gold-backed currency.
Yeah,
Absolutely right, by the way, on that.
him and others have done research, and they think China has more like 30,000 tons, not 2,200.
They
Yeah,
must be, I think, between 30 and 100. It wouldn't shock me they have 50 or 60.
yeah,
As a South African who's in South Africa, who knows about subsistence miners and wide boys crossing borders and buying gold nuggets from subsistence miners scratching in the ground, all that is going up to Dubai refined and through borders to Hong Kong and
yeah.
Beijing. All of it, all of it. And Dubai, the Arabs are there's a mint there. They're melting down. They're doing a meltdown for them, and they want 4 nines. And it's all going east, all going
Yeah.
east to China, not even to India. It's all going east. You can't put a number to that. You
Yeah.
can't even put a number to that.
The global monetary landscape is shifting in ways few are openly acknowledging. While headlines focus on dollar strength or weakness, the deeper story lies in the quiet eastward flow of gold. From artisanal mines in Africa to refiners in Dubai, vast quantities of physical bullion are being transported to China, with some analysts estimating reserves that far exceed the official numbers. This accumulation suggests a long-term strategy, one that could eventually underpin a gold-anchored financial system, altering the balance of global power. Against this backdrop, precious metals markets are flashing critical signals as technical structures point to major inflection points. FrancisHunt, also known as the market sniper, a technical analyst recognized for his macro trading frameworks, and Mario Innecco, a seasoned expert on monetary history and markets, highlight how inflation adjustments, whether using official CPI or shadow statistics, reveal breakout patterns in both gold and silver that mainstream analysis often overlooks. Hunt explains the significance of rising wedge structures and why the current setup is not a sign of breakdown, but rather of melt-up potential. In parallel, silver has quietly confirmed a symmetrical triangle breakout, an incredibly bullish long-term development. These insights remind us that while official narratives dismiss gold and silver, the technical and geopolitical evidence suggest a powerful revaluation is already underway. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
That's gold. If we just share it, that's how it looks. Let me go out on the same kind of time frames that you were doing. And there's this tendency. I'll just take all my drawers off because it's looking a bit messy.
Yeah.
There's a tendency for everyone to say that's got to break down. It's a rising wedge. Yeah, you don't know your technical analysis. And I'm like, no, 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 no. We have 3 types of rising wedges, and we categorize that in our theory that you'll learn, and we tell you how to differentiate between the 2. And the type 3 is the melt up out the top rising wedge. You get the type 2 that's a pop out and then a breakdown, and then you get the one that just breaks down. And you've got to know the difference when which applies. And if I do this for you and I divide it by the CPI, and this is why I say technical analysis theory is very incomplete, and some of the numbers that people will throw out are absolutely contrived. But it's still an adjustment. That is actually an ascending triangle, which you should expect to break out. So should you have any concerns about trading long a rising wedge, but it's so high, let me just help you with that. You've just broken, it's barely started. In HVF method, the triggering just-in-time event only occurred here. And we marked that day and we YouTubed on that day and said, you've now, on an inflation-based, adjustment-based, just triggered a mega move. And we have a target and a stop loss for that as well. If you're in our community, you'll find all about it. But just make that point as well, Mario. Let me hand back to you.
I just wanted to say that one of the viewers said that, and I think I heard that from a friend of mine, this company EMX, they've merged with another company and it's now called Element. So I'm sorry if I said this is a good, well, it is still a good royalty company. Yeah, that's interesting. So it's CPI AUCL?
Yeah, so the CPI is the inflation bit. And
Mm.
the AU means all urban.
Yeah, all urban, yeah.
Yeah. And then CSL.
I guess if you used John Williams calculate
Much
CPI,
better. You
it
and
would
what you
be
all you
much
would
more
get,
falling, wouldn't it?
it would, instead of being an ascending triangle, it will move down to a
Yeah,
symmetrical one. And in fact, if again, I'll just call it back if I may, because if you look at the silver, your gold would look like how silver is when you do the CPI. It'll just be slightly more squared up and less ascending by
yeah,
structure. Again, still a symmetrical triangle. So if you do the same with silver, which is, as I say, something I do a lot for the community here, that's silver done on the same basis. And this is why it's such a significant moment. This is the quarter that silver breaks out, guys.
yeah,
That's super bullish. That on our third takeout. So that's our third impulse. That's our second. And that's
mm,
the huge macro 1980. And that is your, again, your symmetrical triangle breakout. You have just broken out on a symmetrical triangle on silver, which is incredibly bullish on their numbers, inflation adjusted, which
yeah,
would be even lower again if Mario, as Mario suggested, if you're using John Williams. But I suggest to you that the gold one I showed you before, which was very ascending, would look more like this if you were using shadow stats.
yeah.
A little bit more squared up, a little bit
Okay.
lower slung. So hopefully that makes sense. I want to say things like, Indonesia and Malaysia and Bali and places like that that are outside of Australia, but in that lower part that are kind of playing between Singapore and China. I would add those into Mario's suggestion. I like familiarity, so no one's going to give me a high score for saying Southern Africa, but actually, in a weird way, it's very good for getting raw food, lots of farmers. That's impossible to get in between on the food chain. I'm not just thinking of gold and silver. I'm thinking of if you're talking a full-blown reset, everything's solar. People are geared up for that. Everyone is power independent, water independent, who has money. There's good areas. It's very secure, despite what you hear. There's parts like favelas in South Africa. I mean, in townships in South Africa, like favelas in Brazil, where the stats get skewed. But there's actually a very good lifestyle, and it's 40% lower than everywhere else in Europe and the first world. But that said, for people who don't buy my story, which I can accept because of the headlines, you've been brainwashed out of it. Uruguay is a great suggestion in Latin America. Panama is also considerable, but even closer to the US. The thing is, it's a very important port and transmission way. So it's not the kind of place that gets bombed in a war because everybody needs it. The infrastructure, it's critical infrastructure. If you're not afraid of the Russian factor, actually some of the Eastern European nations give quite good lifestyle. Croatia, Hungary, and Poland are making the right kind of noises in terms of, indigenous and other things, but they are under the belly of the warring border.
Yeah.
And yeah, I don't know if we've missed anything.
I think
Everybody
even
wants you to go to the Middle East, and I don't fall for the whole Dubai,
yeah.
UAE thing. I'm not a buyer. It's a trap, it feels like.
Well, I think a lot of Westerners are actually going to Russia as well. I actually think that would be a good place to be. And Russia's got so much land, it's self-sufficient, but it's a bit
The tax,
controversial.
communist nation. I think the personal tax, I'm going to get this the wrong way around. Someone will correct me, but you double check it. The corporate tax, 15%, the personal tax, 20%.
No, I think the personal tax is like 13%. There's only
Yeah.
one tax.
It's low teens and the corporate, no, but if you run a business and you will still pay a business tax. There is a
Oh,
business,
okay.
but very low relatively to what you're paying in the United Kingdom.
Oh, yeah.
And even America,
Yeah,
the land of the free and capitalistic.
I know.
The current financial structure is showing deep cracks that go beyond day-to-day market noise. A 55% collapse in the bond market has forced capital into equities, creating an illusion of strength at record highs while masking structural fragility. For decades, investors were conditioned to rotate between bonds and stocks. Still, that cycle excluded gold, which has quietly become the best-performing major asset over the past year, especially when measured against miners. When priced in gold ounces, equity markets look far less impressive, with ratios like the Dow to gold and FTSE to gold clearly rolling over, exposing the true extent of the debt and fiat collapse. Sharp tremors, quick recoveries, and marginally higher highs that lulled investors into complacency before severe crashes followed. Today, equity valuations are even more extended, with market capitalization running more than double the size of GDP. Against this backdrop, consumer weakness, housing pressures, and collapsing purchasing power point to asymmetry, limited upside and extreme downside risk. These signals together suggest a market vulnerable to another sharp leg lower. Let's get back to the interview.
You're in a debt and fiat-based collapse. The debt market fell 55%. Remember, 60-40, they took it away from being a three-way thing and made it a two-way thing that didn't include gold, bonds or stocks. So when a bond market crashes, the programming over the last 40, 50 years is you do the other thing, the stocks. So everybody who's it's been hearing that the bond market is terrible performing and not paying sufficient yield for the current inflation rate and is in financial repression a la the 70s, only a hyper version, which is why we say it's not even stagflation like the 70s, it's hyper stagflation. Everyone's crowded out and into the other part of the room. However, some people like Mario, like Clive Thompson, like other good brokers have said, hey guys, remember this third thing. And actually, the market has been running like the best performing market, quite clearly, over the last year is in fact gold, and the miners even more so. Let's just leave it. But in terms of asset categories,
yeah, I've got the Dow. Sorry, just I got the Dow gold ratio here, and like what you said, we have a debt collapse.
Fiat, it's a debt fiat collapse. You see,
yeah, that fiat
people
collapse.
have to understand that it's both.
Yeah. But people are saying, oh, the stock market is all-time highs, the FTSE's above 9,000. But I've got the Dow gold ratio here, and since the beginning of the year 2025, it's down from where was it in the beginning? It was around 17. And now we're at 1250 and it's keeling over. So all it means is that people, yeah, if you price anything in confetti, it's going to look a lot better than if you price it to gold. And the FTSE is even worse. I can do the FTSE as well. And you'll see how bad that is. Let's see, FTSE index. Look at how horribly the FTSE is done.
Abysmal.
It's a bit, and people are saying, oh, they think they're doing well. I've got my
Hot.
and they're not.
Debasement. So the point is that both of us are saying, and we need to get back to the question that the individual asked.
Well, yeah, I've got a chart here of the GDX. Francis, sorry to interrupt you.
Go ahead.
We'll get there eventually. I guess in the beginning of April, we had a dip here from April 3rd to April 8th so about a week, and then it just picked up and it's been going up. So there might be, if there is a correction in the general stock market, maybe the miners might dip a little bit, but if anything, it would be, in my opinion, an opportunity to buy even more.
So going back to the three different tops that were substantial, 2008 and 2000. And the point Mario and I took a little sidebar on there and both explained is that actually in gold ounces, shares are a bad investment. I made my own reasons and justifications for why I felt I was right in February. It's down and it's still down, and it fell 27%, which is very violent and has huge downside beta possibility and limited upside beta given it's hypervalued. So that's all the extensive asymmetry risk to the downside and very moderate to the upside. And gold ounces are clearly beating it. Again, gold's investment. So going back to the question, what was shown in these charts is in 2008, you often get this broadening structure. You get a shock, and then it gets shaken off and complacency returns and you make a marginally new high. And then everybody's, every dip is a buy, everybody's dip. This is typical of how they often ends. Only the next time you get hit, it's even more volatile. And when we talk about what's actually happened is you have a bubble of a bond market that has begun revaluing downside. It hasn't even really done that much, but it's had 55% down. but it needs another 55 on what's left, another 55 on what's left, and another 55 on what's left. But you're having a bit of a slight decrease of the bubble in the bond market. That's led to a supreme overvaluation, relocation bubble into the US equity markets. And what ends up happening is all things that are hypervalued, that are unsustainable, will no longer survive. Don't forget, Amazon still 50%, just over 50% is still consumer. It's Amazon.com, what you buy. The rest with the governments and the military industrial complex and the server farms, okay. But its earnings goes down when you stop buying Amazon stuff and taking deliveries. And a wrecked consumer quickly leads to that. An unemployed consumer quickly leads to that. An overvalued housing market that's crashing, that someone can't make a mortgage payment, quickly leads to that. So what he's highlighting is 2008, you got this chop of volatility, and then you went into the massive down leg that was 2008, that he didn't even show the bottom, which came right much later in 2009. So let's go back to 2000. He's showing you again on 2000, which is why it's an interesting post, and it's not mine, Great Mattis, Great_Martis, I believe it is. So you can give him I just thought what he did was technically interesting, and it was worth giving him a shout out. You got the exact same in 2000. 99 July, hey, we had quite a strong collapse down to 10K. Support, run the previous high at 11.2, run all the way up to almost the next 1,000, almost 12,000, 11.8. Then came a bigger smash, and this is the beginning of volatility. You start to get this. Marginally higher, bigger lows, supreme volatility, and then you just get the crash, and it keeps going. So it had a rally all the way back. Oh, okay, bit choppy out there, but we're still close to all-time highs, and you're going to hear that, and then it's done. So I think you'll get a nominal correction as well as a gold ounce correction, even though it's down on gold ounces since the correction that came in April that we warned about in February. So I don't know if you understood that. I can say it again slowly, but I think you're still going to get in nominal terms a correction, because 220, that means 200. The market cap of the stock market is 220% that of the GDP of the country.
Yeah.
So
I think
the
previous high was 195%, wasn't it? That's what.
Yes, and that's 99, I think, which is extreme.
Yeah.
The reality is becoming clearer with each passing quarter. The foundation of today's financial system is no longer built on stability, but on an ever-growing reliance on debt, fiat expansion, and speculative flows. When the surface looks strong yet the structure underneath is fragile, history shows it never ends well. Gold, silver, and hard assets are quietly reasserting their role as the actual benchmarks of value, while equity markets and paper wealth remain dangerously overextended. For investors who can see through the noise, this is a period to recognize that cycles repeat, leverage unwinds, and real wealth preserves itself in tangible stores of value. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.